Welcome to the Deep Dive, where we take stacks of information and, well, we pull out the key insights just for you. Today, we're diving into the recent earnings call for Research Solutions, Inc. That's ticker symbol RSSS. They just reported their Q4 and full fiscal year 2025 results.
Yeah, it's an interesting one. If you just glanced at maybe some headlines, you might think, mixed bag. Revenue was a slight miss.
Right, exactly.
Yeah.
But the market action after hours told a different story. The stock was actually trading up, wasn't it? Around 6% on higher volume.
It was, which suggests, a bit of cautious optimism there. So our mission today really is to cut through that surface noise.
Yeah, let's summarize the main financials, but more importantly, let's really unpack the strategic shifts, the guidance, and give you the takeaways that, really matter for understanding where RSS is headed.
Absolutely, because I think you're right. The market is definitely looking beyond that slight revenue miss. It's focusing on the underlying story, the pivot, the recurring revenue, the profitability path. That seems to be the real narrative here.
Okay, so let's lay that foundation. Give us a snapshot of the Q4 results first.
Sure. So for the fourth quarter of fiscal 25, GAAP EPS came in at 7 cents. Now, that was significantly better than the 4 cents analysts were looking for. So a definite beat on the bottom line.
Okay, strong EPS beat. But the revenue?
Revenue was $12.4 million. The estimate was closer to $12.8 million. So yeah, a slight miss there.
But still up year over year.
Still up 3% year over year, which, in itself isn't bad. But like we said, it's not the whole picture.
Right. That 3% feels like just, one data point. Because the underlying trends you mentioned seem much stronger. Let's talk about ARR, annual recurring revenue.
Exactly. This is where it gets interesting. ARR grew a really robust 20% year over year. It hit $20.9 million.
And that's critical for any company moving to SaaS, right?
Yeah.
That predictable revenue stream.
Absolutely critical. It shows stickiness. And digging deeper into that revenue mix, the platform subscription revenue, that jumped 21% year over year to $5.2 million.
Okay, 21%. And didn't they say something about its share of total revenue?
They did. For the first time in Q4, platform subscriptions made up over 40% of their total revenue. That's a huge milestone.
Wow. So you can really see that shift happening, moving away from the one-off transactional stuff.
Precisely. It's a fundamental change in the business mix, and it impacts margins too.
Ah, yes, the margins. That really jumped out at me. Gross margin expanded by, 450 basis points.
A huge jump, 450 basis points year over year, hitting 51%. And that's the first time their blended gross margin cracked 50% in a quarter.
Okay, crossing 50% gross margin. What does that really tell us? How significant is that milestone?
It's incredibly significant. It's not just a number. It suggests the quality of their earnings is improving dramatically. They're growing, yes, but they're growing much more efficiently. It points towards a fundamentally higher margin business model taking hold.
And that's reflected in EBIT too.
It is. Adjusted EBITDA, which kind of strips out some of the non-cash items and gives a clearer operational picture, was up 15% year over year to $1.6 million. These aren't small tweaks. They show a much healthier financial base.
Okay, so strong Q4 trends underneath the surface. What about the full year? Fiscal 2025 overall.
Record year. Really strong. Total revenue hit $49.1 million. That's up 10% from the previous year.
And the platform revenue component of that?
That was $19.0 million for the full year, which is up a massive 36% year over year. Huge growth there.
36%. Wow.
Yeah. And they also hit record adjusted EBITDA for the year, $5.3 million. And that pushed their full year adjusted EBITDA margin past 10% for the first time ever.
Okay, so hitting that 10% adjusted EBITDA margin threshold for the full year, that really validates the strategy, doesn't it?
It absolutely does. Consistent improvement in that core profitability. It shows the plan is working.
All right, so we've seen the numbers, the ARR growth, the margin expansion, the profitability.
Yeah.
All pointing in the right direction.
Yeah.
But these results don't just, happen. They're driven by a very deliberate strategy.
Exactly. A pretty bold strategic play, actually.
Let's dig into that. This transformation, the pivot towards SaaS and AI, management really emphasized this on the call, didn't they?
They did. They made it crystal clear. This isn't just tweaking the model. It's a fundamental shift. They're moving away from being primarily, a transactional document delivery service, like you said, an on-demand library.
Right.
And they're moving towards becoming a high-margin, subscription-led vertical SaaS platform, specifically focused on the R&D space.
And the Scite acquisition seems absolutely central to this.
It's proving absolutely pivotal, not just for the content it brought, but because it's AI native. It helps shift them from just providing documents to providing, well, AI-powered intelligence around that content.
That's a key distinction, moving up the value chain.
Exactly, delivering insights, not just articles. That's where the value and probably the pricing power is going forward. And they even quantified it. AI-based products are growing almost 4 times faster than the older stuff.
4 times faster. That's a strong signal.
It really is.
And this ties into something else they mentioned, the rule of 40. They calculated it at 34 for fiscal 25 and said they're focused on improving it. Can you just quickly remind us what that is and why 34 is significant here?
Sure. The rule of 40 is a benchmark for SaaS companies. You basically add your revenue growth rate percentage and your EBITDA margin percentage. If it's over 40, that's generally seen as a sign of healthy, sustainable growth.
Okay.
So being at COM4 shows they're getting closer. It signals they're balancing growth with profitability. They're investing heavily in growth, hence maybe not being over 40 yet, but they're doing it while keeping an eye on the bottom line. It shows a mature approach, not just growth at all costs.
Right, a conscious trade-off.
Yeah.
Investing now for future profitable growth. Makes sense. So how are they actually driving that growth? One strategy that sounded really interesting was this headless platform approach.
Yeah.
What exactly is headless here?
Yeah, headless is a key pivot. It basically means the core technology, the engine behind Scite and Article Galaxy, can be accessed through APIs.
API, so application programming interfaces.
Exactly. So customers don't have to use Research Solutions' specific front-end interface. They can take that engine, that intelligence, and plug it directly into their own systems, their internal dashboards, their workflows, even their own AI tools.
Ah, so decoupling the brain from the body almost.
Kind of, yeah. It gives customers huge flexibility, and it leads to much stickier, often larger contracts because Research Solutions becomes deeply embedded in the customer's own infrastructure. They mentioned some of their biggest deals ever are these API-first headless deals.
And that ties into some older assets too, right? Those Resolute databases.
It does. That's a smart point. They acquired these 13 curated databases with Resolute a while back. Now they're kind of resurrecting them specifically for this headless strategy. They can offer this unique structured data via API to clients building their own AI solutions.
So unique data fuel for customer AI. That sounds incredibly sticky.
Very sticky. And it gives them an edge over just using generic AI models because this data is curated and specific.
Yeah, another new thing was the AI rights add-on. This sounds like it hits a major nerve right now, copyright and AI.
Absolutely. This is a brand new offering. It's designed to give companies peace of mind that when they use AI with scientific literature through Research Solutions, it's copyright compliant.
Which is huge for, say, pharma or biotech R&D teams, right? They can't risk infringement.
Exactly. Compliance is paramount for them. So this add-on addresses a critical barrier to using AI for research. It ensures the AI models are trained and used responsibly with properly licensed content.
Yeah.
It's a new revenue stream. And they said feedback from both customers and publishers has been really positive.
That publisher buy-in is key too.
Crucial.
Okay, shifting gears slightly, M&A. Acquisitions, they sounded pretty active here. Revamped strategy, strong pipeline.
Yeah, they definitely signaled more activity on the M&A front. They've rebuilt their pipeline, focusing on targets with, quote, realistic valuations. They expect to close 1 or maybe more deals in fiscal 26.
And the goal is to add new workflows or content, accelerate the platform growth.
Precisely. It's about speeding up that transition via acquisition, not just organic growth. And they mentioned financing it primarily through senior debt and cash.
Which speaks to their balance sheet strength, which we'll get to.
Right. And interestingly, they said they prefer deals where the sellers stick around and help grow the business, although the deals themselves would likely be mostly cash at closing. Suggests to focus on integration.
Okay, and what about just selling this stuff? The go-to-market strategy. There was a new chief revenue officer.
Yes. Hired back in November 2024. And apparently, they've significantly overhauled the sales approach, the result. A noticeable increase in larger B2B contracts. They highlighted several deals over $100,000 in ARR.
So bigger fish. Not just more deals, but higher value ones.
Exactly. Critical for scaling the SaaS platform. And an interesting little tidbit, the academic segment, while smaller, less than 20% of customers, is actually their fastest growing segment right now.
Faster growth in academia. Interesting. Maybe Scite is really resonating there.
Could be. Or maybe it's just an area with less penetration previously. Definitely something to watch.
Now, we do need to touch on the other side of the coin, the legacy transactional business. Revenue there declined in Q4, and they expect that to continue for a bit.
Yeah, Q4 transaction revenue was $7.3 million, down year over year. And they guided for that trend to continue in the first half of fiscal 26.
And part of that is this zero-click search phenomenon driven by AI, right? Explain that again quickly.
Zero-click search is basically when a user asks an AI, like ChatGPT or similar, a question, and gets a satisfactory answer directly from the AI without needing to click through to the original source document.
So the AI synthesizes the answer, and the user never needs to buy the underlying article.
Exactly. If your research solutions and your business was partly built on selling access to those articles, that's a headwind. They did surveys suggesting about 10% of their transactional customers are buying fewer documents because of this.
Okay, so it's a real impact. How are they countering it? They mentioned suggestive selling, trying to be the Amazon of Doctile.
Yeah, that's their adaptation strategy. Instead of just fulfilling a specific document request, they want to intelligently recommend related papers, maybe follow-up research, perhaps even relevant AI tools or platform features based on what the user is looking for.
So anticipate the next need, like Amazon does.
Exactly. Try to turn that initial query into a larger transaction, or ideally, maybe even nudge them towards a platform subscription where they get broader access. They said early tests of these initiatives are showing some promise, so they're not giving up on transactions, but evolving the approach.
It's smart, adapting to the AI world. Okay, but despite those headwinds, the profitability and cash flow picture looks, well, incredibly strong.
It really does. This was maybe the most impressive part. Record operating cash flow for fiscal 25, $7.0 million. That's almost double the previous year.
Double the cash flow.
Yeah. And their cash balance, it grew from just $2.7 million 18 months ago to $12.2 million now. And importantly, they have zero debt outstanding.
$12 million in cash, no debt. That gives them massive flexibility, doesn't it? Especially with those Scite earnout payments still due.
Huge flexibility. The total final Scite earnout is $15.4 million, paid quarterly until May 2027. It's mostly cash, 62% cash, 38% stock. But even funding that, they expect their cash balance to increase by the end of fiscal 26.
So they can pay the earnouts and still build cash.
That's the projection, which, leaves plenty of dry powder for the M&A they were talking about.
Right. And that platform gross margin you mentioned earlier, 88.5% in Q4. That just seems unbelievably high. How?
It's exceptionally high. They attributed it to a few things. Efficient labor management, some prepayments they made for hosting like AWS, which locked in costs, and also just the fact that underlying AI services are generally getting cheaper over time.
So a combination of good management and favorable tech trends.
Exactly. It really underscores the potential profitability of this SaaS model they're building. 88.5% gross margin on the platform side is just stellar.
Okay, so let's bring this all together. Why does this matter for you, our listener? What's the big picture takeaway?
Well, I think this call really shows a company that's navigating a major strategic shift pretty successfully. Yes, there was that slight top-line miss, but look underneath.
Right. Strong ARR growth, massive margin expansion, record profits, record cash flow.
Exactly. All those underlying trends point to a business that's becoming much more resilient, much more valuable. They're leaning hard into this AI-first, API-driven platform strategy, and that positions them right in the middle of a high-growth, high-margin area. The market seems to be recognizing that.
Yeah, the key themes seem really clear. That shift from one-off transactions to sticky recurring revenue. Leveraging AI not just as a feature, but as a core part of the workflow. Building these integrated, headless solutions.
Now, those are the defining characteristics now, I think. It's a very different company than it was even a couple of years ago.
So looking ahead, what should people be watching for? What are the key milestones or metrics?
Definitely keep an eye on their progress towards that $30 million platform ARR target they've set for fiscal 2027. That's a key aspiration.
You have $30 million ARR by FY27.
Yeah. Also, continued growth in Scite specifically, adoption of that new AI rights offering, are companies signing up for it. Any news on M&A deals closing, especially ones that add significant ARR capabilities.
And maybe some big customer wins using that headless platform approach.
Exactly. Marquee accounts signing up for API access would be a great validation point. And then on the other side, watch if that transactional business stabilizes or starts to recover in the second half of fiscal 26, like they hope.
Lots to track there. Okay, let's move to our favorite segment. This is not financial advice.
Yes, the disclaimer part.
Absolutely. Remember, everyone, this is purely for entertainment, maybe sparking some ideas. It is absolutely not financial advice. Always, always do your own research and due diligence before making any investment decisions.
Okay.
Got it. Good.
Disclaimer delivered. So what's the outrageous but plausible idea this time?
All right, think about this. Research solutions. ton of cash flow, zero debt, explicitly talking about doing M&A soon to boost that platform ARR.
Okay, setting the stage.
The market maybe hasn't fully priced in the potential impact of a really smart, accretive acquisition happening relatively soon. They've got the cash, they've got the debt capacity, they've got the pipeline. They sound ready to pull the trigger.
Right. Management sounded quite confident about finding deals.
So the trade idea, maybe a bull call spread on RSSS.
Okay, a bull call spread. Buying a call, selling higher strike call, same expiration. Limited risk, limited reward, moderately bullish bet.
Exactly. The thesis is an acquisition gets announced in, say, the next year or so, something that clearly accelerates them towards that $30 million ARR goal, or maybe gives them unique AI content rights.
Something that forces the market to reevaluate the company's growth trajectory.
Precisely.
Yeah.
And that kind of catalyst could cause a fairly rapid repricing of the stock, making those out-of-the-money calls potentially quite valuable.
Yeah.
You'd probably look at expiration dates out in late fiscal 26 or early 27 to give the M&A and the strategy time to play out.
So leveraging the strong financials and the M&A potential against what might be maybe a slightly undervalued perception right now.
That's the idea. Again, not advice, just something to think about. Food for thought.
Definitely food for thought.
So recapping today, we looked at Research Solutions Q4 and full fiscal 25. Strong underlying performance, really driven by that successful pivot to a higher margin AI-powered SaaS platform.
Yeah, impressive recurring revenue growth, big jumps in margin, great cash generation, all supported by a pretty clear strategic vision for how they fit into this increasingly AI-driven research world.
It feels like, as the world deals with things like zero-click search and AI answer engines, Research Solutions is trying to position itself as the crucial bridge, the compliant, safe way to connect valuable proprietary content, licensing, and reliable AI.
Almost like becoming the trusted infrastructure for scientific AI. That seems to be the ambition.
Yeah. The challenge now, of course, is execution. Keep up the sales momentum, especially those larger deals, accelerate that transactional pivot, and keep integrating AI effectively.
Sustaining that execution is key.
Well, we hope this deep dive helped you understand the layers beneath the headlines for Research Solutions. We definitely encourage you to dig deeper into these trends yourself.
Absolutely. Consider how these shifts might shape the future of research and maybe your own portfolio.
Thanks for tuning into the deep dive. We'll be back soon with another look at the latest earnings.